This video discusses the equity method of accounting for a stock or equity investment. If our shareholdings or ownership stake accounts for between 20 and 50% of the investee's total outstanding shares, we use the equity method. And that's because an investment, direct or indirect, of 20% or more of the voting stock of an investee leads to the presumption that in the absence of any evidence to the contrary, that we, the investor, have the ability to exercise significant influence over the investee. We'll have a fair amount of say when it comes to appointing or voting for the board of directors, and in turn, influencing decisions made by the investee corporation. If it's a closely held corporation and another investor, let's say, owns 55% of the shares, obviously, we might not have significant influence and we might not use the equity method. But the absence of evidence to the contrary, share ownership between 20 and 50%, leads to the equity method. Let's take a look at how we account for that. What we will do is we will record the investment at cost, just like we would under the fair value method, but we will subsequently adjust the amount each period for our proportionate share of the investee's earnings or losses, and then any dividends that we receive as well. Net income or profits will increase the value that we have recorded for our equity investment on our books, and losses will decrease the equity investment account. Dividends that we receive are considered to be a return of our investment and decrease the investment balance. To the extent that any accumulated losses or dividends received exceed the carrying amount of our investment, we will generally discontinue applying the equity method because we don't want or can't really carry assets at a negative value. We will discontinue recognizing additional losses. Let's take a look or compare how we account for investments using the fair value method with the equity method. In both the fair value method on the left and the equity method on the right, we account for our initial purchase exactly the same way. If we acquire 48,000 shares at $10 a share, we will debit equity investments for $480,000 and credit cash. Let's go ahead now and see how the methods are different. Let's assume that for the year, for the period, that our investee, the mini company, the smaller of the companies, reported net income of $200,000, and that we owned 20% of the investees or the mini company's stock. Well, 20% of the $200,000 is $40,000. And using the equity method, we will increase equity investments on our books by $40,000 and record $40,000 of investment income. And that investment income will, of course, flow through to our income statement. Recall, on the fair value method, if our investee reports earnings, it does not at all impact the carrying value of the equity investment on our books. But on the other hand, at December 31st, 2020, year end, if we're accounting for our investment using the fair value method, we need to adjust the value of our equity investment based on the fair value of the mini company. And so if the market price has risen to $12 a share, we will debit our fair value adjustment and credit an unrealized holding gain or loss. And again, that unrealized holding gain or loss will also flow through to our income statement. On the other hand, if we're using the equity investment, we do not make any adjustments for changes in fair market value. Let's move on to some transactions in the second year of our investment holding. In the second year, on January 28th, we receive $20,000 in dividends. In both cases, we receive $20,000 in cash, and regardless of our accounting method, we debit cash for $20,000. If we are using the equity method, we assume we are getting a return of our investment, and we credit equity investment for $20,000. On the other hand, using the fair value method, less than 20% shareholder interest, we report dividend revenue of $20,000. And of course, that dividend revenue flows through to our income statement. Once again, at year end, we're going to record or report our proportionate share of the mini company's earnings or losses. In 2021, the mini company reports $50,000 loss. Our 20% share is $10,000. So we will record an investment loss, and that loss will flow through to our income statement, and we will reduce the carrying value of our equity investment on our books. Using the fair value method, no entry is made at that time. However, the other thing we do at year end is we need to make a fair value adjustment if we are using the fair value method. And we're told that on December 31st, 2021, the fair value of the mini company is now $11 a share. There's been a decline of $1 a share since the prior year. So, using the fair value method, we report an unrealized holding loss, and we reduce the fair value adjustment account with a credit. On the other hand, the equity method, no entry is made. Let's go ahead and walk through a few problems. We're told that for $282,000, the Culver Corporation purchased a 30% interest in Murphy, Inc. So it's between 20 and 50%. So absence evidence to the contrary, we'll use the equity method. The investment enables Culver to exert significant influence over Murphy. During the year, Murphy earned net income of $172,000 and paid dividends of $65,000. Let's go ahead and take a look at the journal entries. To record the purchase, of course, we will debit equity investment for $282,000, the cost of that investment, and credit cash for $282,000. Now, during the year, Murphy earned earnings of $172,000. Our proportionate share of that is 30%. So we will increase the value of our equity investment by $51,600. That's again 30% of $172,000, and we will report investment income on our income statement of $51,600. On the other hand, when we receive the dividend, they've reported or paid dividends of $65,000. Our share of that, 30%, will be $19,500 is how much we'll receive in cash. But rather than reporting dividend income, which we would do under the fair value method, since we exert significant influence and are using the equity method, we reduce the carrying value of our equity investment. We are presumed to have a return of capital of $19,500. Let's take look at a few additional questions. What percentage ownership indicates that investor has significant influence over the investee? That was our between 20 and 50%. What method of accounting do we use? We use the equity method. Now, here's a more interesting question, a little bit more challenging. What amount is our equity investment reported on our balance sheet? Actually, it's not that challenging because we see we had an original debit of $282. We had an additional debit of $51,600, and then we credited the equity investment for $19,500. So we will carry this on our books at $314,100. That's the $282 plus the $51,600 less the $19,500. And finally, where do we report our investment revenue on an equity investment? Below net income line and other comprehensive income, or is it included in net income? And the answer was it was included in net income.